to welcome you to this session with Chairman Jay Powell. Let me just say a few things before I turn the program over to him. The Federal Reserve, as the nation's central bank, has important public responsibilities for our nation's financial and economic stability. We're a supervisor and regulator of banks. We seek to ensure the smooth functioning of the payment system. And of course, we have responsibility for conducting monetary policy. To serve a nation as large and diverse as ours across each of these mission areas, Congress recognized more than a century ago that the Fed would need to be engaged with communities and the public it serves. The Fed's structure, with a Board of Governors in Washington, D.C., and 12 Federal Reserve banks headquartered across the country, was designed in part to ensure broad public involvement. At the Kansas City Fed and our branch offices in Denver, Oklahoma City, and Omaha, we meet regularly with community and business leaders across the 10th Federal Reserve District to provide us with insight on current and developing economic and banking conditions. Individuals from all facets of our economy, from business, banking, agriculture, energy, healthcare, labor, and community organizations, serve on our boards of directors. They participate in advisory councils, and they share their views with us in roundtables and events such as this one that brings us together today. As this region's representative to the Federal Open Market Committee, the input I receive through these various channels is an important element in shaping my policy views. Today's dialogue is one in a series of events that have been held nationwide as part of the Fed's review of its monetary policy strategy, tools, and communications practices. Understanding how you experience the economy is an important aspect of our ability to fulfill our congressionally mandated objectives for stable prices and maximum sustainable employment. As the title of this event suggests, we are here to listen and hear your thoughts and concerns. And now it is my great pleasure to introduce to you Chairman Jay Powell.
Thank you very much, Esther, and good morning. I'm very happy to be here in Kansas City for what is actually the 13th of 14 Fed Listens events around the country. And I look forward to hearing the perspectives of the community and business leaders we have participating here today. So we've been holding these events around the country as part of a comprehensive and public review of our monetary policy, strategy, tools, and communication practices. Almost all of these meetings, like this one, have been open to the press and live streamed on the internet. And both the breadth and the transparency of the review are unprecedented for the Fed. One reason we're conducting the review is that it's always good practice for any organization to occasionally take a step back and ask if it could be doing its job more effectively. But we have to pose that question not just to ourselves, because Congress has granted us significant protections from short-term political pressures. We have an obligation to clearly explain what we're doing and why we're doing it. And we have an obligation to actively engage the people we serve so that they and their elected representatives can hold us accountable. We've invited you here because we want to better understand how monetary policy affects your lives and the lives of the people your organizations represent. We want to hear your perspective on maximum employment and price stability, as Esther mentioned, the monetary policy goals Congress has assigned us. We think now is a particularly good time to conduct the review. Unemployment is at a half-century low, and inflation is running close to, but a bit below, our 2% objective. While not everyone fully shares economic opportunities and the economy faces some risks, overall, the economy is, as I like to say, in a good place. Our job is to keep it there as long as possible. While we believe our strategy and tools have been effective and remain effective, the U.S. economy, like other advanced economies around the world, is facing some longer-term challenges from low growth, low inflation, and low interest rates. While slow growth is obviously not good, you may be asking what's wrong with low inflation and low interest rates. Low can be good, but when inflation and consequently interest rates are too low, the Fed and other central banks have less room to cut rates to support the economy during downturns. So in this review, we're examining strategies that might better allow us to symmetrically and sustainably achieve 2% inflation. Doing so would help prevent inflation expectations among consumers, businesses, and investors from slipping too low, as they appear to have done in several advanced economies. More firmly anchored expectations in a virtuous circle would help keep actual inflation around our target, thus preserving our ability to change interest rates as appropriate to meet our mandate. We're also looking at whether our existing monetary policy tools will be adequate when the next downturn comes. Finally, we're asking whether our communications practices can be improved to better support the effectiveness of our policy. After today, we have one more Fed Listens event remaining later this month in Chicago. At the July meeting of the Federal Open Market Committee, my colleagues and I began discussing what we have learned so far from these events. We continued that discussion at our September meeting, and we have a lot of work left to do. We plan to publicly report our conclusions during the first half of next year. One clear takeaway of the session so far is the importance of sustaining this historically strong job market. People from low and moderate income communities tell us that this long recovery, now in its 11th year, is benefiting them and their neighbors to a degree that has not been felt for many years. Employers are partnering with community colleges and nonprofit organizations to offer training, and people who have struggled to stay in the workforce in the past are getting new opportunities. So once again, I'm very happy to be here, and now it's your turn to speak. We'll be listening. Thank you.
All right, thank you, Chairman Powell. So this morning, to facilitate this conversation, I'm going to serve as your moderator. And in that role, I'll ask a series of questions where all of you will have the chance to offer some insight. I would ask, as you respond to the question, if you would introduce yourself and your organization before you answer the question. That would be helpful. And we're going to try to keep our comments in the 3-minute mark if we can. We'll flex around that to make sure everybody has a chance to talk. So let me get started with our questions. I want to start with the labor market. Thinking about how the economy is unfolding, we know employment growth in the country has remained pretty solid this year at a time when the unemployment rate continues to be very low. So as you think about what's happening in your industry, in your area of responsibility, we'd be interested in how you would characterize the labor market and the conditions that you've seen over the past year or so. So I'm going to start with you, Ramin, if you'll introduce yourself and offer some insight.
Good morning. I'm Ramin Sharifat, CEO of McCowan Gordon Construction Company. We're a commercial construction company headquartered here in Kansas City, and we work from South Dakota down through the Plains and Oklahoma with a backlog of about $1.6 billion, and about 50% of our work is in the public and private sector. So I'd like to start out by saying thank you to both of you for your leadership. You're doing a wonderful job in representing the business community. So no doubt our industry has experienced a decade of record growth since about 10 years ago, coming off the Great Recession, which was the biggest slowdown that our industry has seen in about 50 years. The number one challenge we have to keep our business growing is people. Plain and simple. Nothing can happen in our market without the right people, both from the professional side, the engineering aspect of things, and also the workforce development. So what we've seen particularly is after the Great Recession, many people left our industry to go try new things. There simply weren't jobs in the construction market. And those folks have left and they haven't come back. And so we have a convergence of a couple of things happening right now with those tradespeople and craftspeople leaving the industry and an aging workforce. We're having a really hard time filling that pipeline with young talent that wants to come in and be a part of the construction industry. So at the same time that that's happening, wages are starting to go up to a point where it's got our attention, and it's concerning to us at the rate that we're seeing wages increase. That I'll stop short of saying it's not sustainable yet, but it's starting to have some reflections of what happened back in 04 and 05 when we saw wages going up to a point that got so high that it made projects unfeasible. So we're not there yet, but that is really clearly in the back of our mind as we've seen what's happened in our market.
Okay. Thank you very much. Yeah. Cassandra, you're going to offer us a view from your business?
Good morning. My name is Cassandra Savage, and I am president of the Savage Group, LLC, And my husband and I own 9 McDonald's restaurants in the Kansas City area, and we are a McDonald's franchise. It's an honor to participate in today's event and to have this opportunity to present our perspective as a local business and local entrepreneurs in the current labor market for our industry. I can only speak for myself. I cannot speak for other McDonald's owner-operators in the area or corporation or for McDonald's Corp. But for our company, our priority is to ensure consistency and adequate staffed restaurants and a reduction in turnover, and that is essential. It's tough to make it happen, too. In general, as we know, the definition of full employment is when competitive jobs are available, but there are not enough workers to fill them. In my opinion, it does not feel as if we are at a max or almost max employment, as there is scarcity in the workforce and growing turnover, which makes it difficult to reach our goals for staffing and retention. The issues are compounded with less participation from youth and other demographic groups in the labor market. As a company in general, we are confident that we have a competitive wage, benefit packages such as Archways programs, which we contribute at least $3,000 a year for scholarships, toward college education, contribution to employee medical and dental insurance packages, competitive wages for hourly, $15 or more, and salary managers and staff that have an opportunity to earn over $50,000 with bonuses. Despite these benefits and opportunities, we do not have enough employees to adequately fulfill our current positions. We will be forced to change the way we do business, and which will have its own set of pros and cons, not the vision that our founder and visionary Ray Kroc had, but times have changed. Answer was the answer, and we talked about that just a little bit, with the chair I did today, is we're going to have to look at automation. And that's going to change the human touch that we've had with our business. McDonald's has always been one that has always been family-oriented, but things will change. But we'll be forced to do that due to the fact of the labor shortage that we are faced with today.
Thank you, Cassandra.
You're welcome.
Clyde, do you want to talk about this issue from your organization's perspective?
Thank you, Chairman Powell and President George. I think the George Washington University convened a study of good jobs in Kansas City, Missouri, and 51% of the good jobs in Kansas City, Missouri require a college degree, yet 49% of them do not. They require a credential. And the challenge that has been addressed here, we break down to what we call a AAA system. 1A is accessibility, the place where training, child care, and work occurs. The second A is affordability, the ability of people to afford training, child care, and travel to and from work. And the third A addresses availability, the time at which training, work schedules, and child care is availability. In a 24-hour economy that we experience in our region, which means we have a 3-shift economy, 8 hours, early, medium, and night, these things are crucial to increasing labor market participation by underserved populations. Many employers come to our organization, and we service urban, rural, and suburban communities, and they say, why aren't people showing up? And it's typically because one of these 3 reasons. They can't get to the place. The child care is not available or not affordable, or the education and training that is necessary, because remember, $55,000 a year plus requires a degree or a certification of some sort, that they can't afford that. In our region alone, when I served on the CDAC, student debt was estimated to be something like in the neighborhood of $1 trillion. I can't even say a billion or a trillion. It's so huge, I can't even think about it. But that is a huge issue in underserved communities. People know about debt, and they don't want it. And quite frankly, when you tell people about that, the thing that they hear is, if you go to training and you go into debt, I can't get a car, I can't go get a house, and so I'm not going to participate. That's why people aren't showing up. And to the extent that we systematize the availability and create a K through 14 system as opposed to a K through 12, where people can access credentialing and education credentials on an easy basis without having to worry about how do I finance it, will increase the ability of people to show up with the right skills at the right time.
So are you getting, have you seen in the last year progress in trying to turn the tide around?
Yes, in fact,
Those
in
three
Missouri,
issues?
we passed a program called Fast Track, which enables persons who, a $25 million state-funded program, which enables people who are over the income level to access training to get a credential, and does not take income consideration. They can be up to $80,000 to do that. Secondly, we passed at the post-secondary level, the high school level, a program called A+, but to try to get dual credit available at the high school level. And then thirdly, we are working with a number of, in fact, HHS is having a program here tomorrow to talk about child care, which is a huge issue in our region. 50% of the families in our region are headed by a single-head household. So if you got to think about child care when thinking about going to work, it's an invaluable component.
Very interesting. So related to this issue, I want to move on to another question, which has to do with how the cost of labor and what you may be seeing in the way of wage inflation. So with this next question, it would be helpful if you would characterize the current pace of wage increases for workers in your industry or business. And do you expect these workers to get higher, lower, or similar wage increases next year as you saw this year? And if so, if you could give some idea of how large or small those increases are going to be. And Karen, if you'll introduce yourself, I'll start with you on that.
Good morning. Thank you. I'm Karen Orozco. I am the Senior Vice President of U.S. Retail for H&R Block. That serves over 20 million clients in the U.S., and we prepare 1 in 7 of every tax returns in the United States. Thank you for the opportunity to share our insights this morning. At H&R Block, we have 10,000 year-round associates, and every tax season we hire about 70,000 seasonal workers across the country. And as we looked at the labor market and the rates it would take to competitively hire them last summer for this upcoming tax season, and consider all the factors, on average for non-commissioned roles, those 70,000, we estimated about a 10% wage increase to allow us to find the right talent for those positions. That was really driven from 2 primary factors. The first being that we're seeing increased competition for that seasonal workforce as a result of retailers who are reducing their fixed cost infrastructure and relying more heavily on seasonal workers. And the proliferation of the gig economy is putting a lot of pressure on those part-time seasonal workers, where they are able to continue to get those jobs that offer maximum flexibility and allow them to really find that fit for themselves. And secondly, what we're seeing is the increase in the minimum wage at the state level. So despite the fact that the minimum wage federally is $7.25 per hour, 30 states have increased their minimum wage to, in some, 2 times more, with additional increases planned in 2015. And that's putting upward pressure on the rates, even for positions that weren't currently planned at that minimum wage rate. It's kind of causing that wage inflation across those positions that we're hiring for. And finally, the thing that we've seen is that it's very localized. So that 10% is a national average. But in certain areas across the U.S., we see a perfect storm coming together. So as an example, in San Francisco, in the Bay Area, you have 3 things happening. You have an unemployment rate that is declined faster in California than the national average, a minimum wage that is above the national average, and an increased consumer demand for those gig services, which is putting more demand on the need for those workers. And in that area, in markets like that across the U.S., we've seen a pace of wage inflation upwards of 30%. So it really does matter where you were operating.
Can I just, so if I can, it seems like from those of you who are wage payers, there's a strong feeling of labor scarcity and concern about wages moving up and that kind of thing. On the other hand, we know that there are big groups that are at the edge of the labor force. We have relatively low labor force participation, and some of that can be addressed, but a lot of the issues, as you were mentioning, Clyde, are around transportation, child care availability, that kind of thing. So it feels like there would be a way to address these concerns, because there are the people who could work if they have these services and have this availability. But is that a fair way to look at the way this is lining up?
I would say that the people won't show up if they can't figure those things out. We see it all the time. They just won't show. And so it's like they don't exist, but they're there. But they know that one thing poor people can do, they can do the math. And what they do is they calculate whether I can afford, I don't want to be successful. And those are the challenges that we see in the people, when we see 25,000 of them, and we see them show up at some place, some employers, at late shift, when they got child care, and we not show them at different shifts when they don't. And so I think that's a key challenge that we see.
Yeah, I think that's right. We have used innovation in technology to help address some of these. So, for instance, our training courses that an individual would take to become eligible to become a tax preparer, we offer those virtually. So it reduces the need for transportation to go to a training and development class, and they can take that from their home as long as they have technology access. Likewise, as we serve more and more clients through virtual products, it allows us to overcome the pressures in some markets by tapping the workforce across the United States as opposed to only having to hire on an office-by-office basis. And so I think you're exactly right. There's a way to work around that, but it does, to Cassandra's point, it does change and put pressure on the need for human help as we use technology to offset the scarcity.
Kim, do you want to offer another view on this wage issue?
Absolutely. Thank you so much for having me. It is an honor to represent the small business. My name is Kim Randolph, and I own InkU. InkU LLC is a construction management firm, and I work with most of the small minority women businesses in Kansas City. For us, wages really don't even count for us. We don't feel like we're a part of the system because we're so small. We do see the wages going up. We see a great increase in wages, but it doesn't affect the small business as well, or as much as it does the larger businesses. We lose employees to the larger businesses because, of course, they pay better wages. In the construction industry, the small business also have a problem with access to capital. So when we go get lines of credit or lending, our interest rates are much higher than the larger firms. So that affects us also. When we talk about do we expect higher or lower or similar increases, for the small business, I think it's going to remain the same. It also, to Clyde's point, we can't keep employees. The cost of coming to a job site or having child care or some of the things that we have to face as a small business, it just, it hasn't changed. And then lastly, do you think it's going to be a small or a large increase? I don't think it's going to move. I think it needs to move. And I think that for the small business, we would like to be more included in the economic decisions that are made.
Thank you very much. So we may come back to both of these issues in the course of some of these questions, but I want to talk a little bit about the other aspect of what the Fed focuses on, and that is how prices and inflation are performing. So this next question is really going to ask you to think about what are the major cost and pricing pressures that your firm faces this year. And Elise, we've talked about this a little bit in some of our other roundtables, but why don't you introduce yourself and the industry you represent?
Thank you, Chairman Powell and President George. It's a huge issue right now. It's because, yeah, we are finally seeing wages increase, but the increase on the wages is real more tied towards health insurance, because health insurance is raising so highly that you can't afford it. So most of the benefits the wages that we're getting on our increases is really going to health and care cost or the Pension Protection Act. We've got to make sure that our pensions are solvable because of our DB plans. That's a big issue. But then you've also got to look at the price of building. So you've got steel and the tariffs, and you know what I mean, the cost of development and buildings also continue to increase. And then also looking at the urban core. The biggest issue really is, as you look at wages increase, and I see them, we haven't had an increase, really large increases, because of the big bust we had in 2008 and 2009, as you all talk. But what people don't understand is the construction industry unemployment rate at that time was in the 20s and 25%. So we lost a lot of that workforce. Some of it came back. We're starting to grow that workforce, but you've got to have a livable wage. And in Kansas City, and when you look at Kansas, which doesn't have a tied minimum wage. We have a minimum wage that everybody's supposed to pay. Well, in the construction industry, our minimum wage is tied to Davis-Bacon on federal or prevailing wage on some, thanks to Missouri and our great municipalities on this side of the state. We have a prevailing wage, so most projects can be paid a livable wage. But when you're competing with Kansas and a livable wage is $10 or $12 for a bricklayer, I'm going to go somewhere else where I'm not going to have that job where I've got to deal with the weather and the aspects, let alone the AAA factor. So the other issue is on that competitive market is if Clyde's paying me $14 an hour, but I'm making 12 here, it's so easy to flip, you know what I mean, with the transit. So everything's tied to having that health insurance and that pension, and that's where all of our wages are all tied to.
So of the most recent increases that you've negotiated, how much, can you just give a proportion?
Sure.
How much went to health and pension versus?
So on the
base?
cement masons, I'm a concrete finisher by trade. On my cement masons, we basically got a raise of 67 cents. 25 cents went on health insurance. 25 cents went on unrecognized pension contributions, meaning we have to have enough because I'm getting older, but as our younger members come in, we want to make sure our pensions are solvent, so they are able to get that. But so basically, I would say about 70 to 80%. Now, some of the wages that have increased this year, we've seen, I mean, even Truman Medical Center was a 3% increase, which is huge for us on a, you know what I mean, on a public health, healthcare. But you're starting to see 3 and 4%. Just because we haven't got those increases in so many years, and we've got to make sure that we keep our future workforce with a great pension and a great health and welfare system.
Okay, thank you. Jeanette, you want to weigh in on this issue, and please tell us about your company, what you do.
Sure. First off, thank you so much for inviting me here today. My name is Jeanette Hernandez-Pringer. I'm the founder and CEO of Echo Select, an IT professional services company headquartered here in Kansas City. We have offices in St. Louis and Washington, D.C., and our clients are Fortune 1000 companies as well as government agencies here in the United States and Canada. Our biggest asset is people. And even though we're in technology, I have a lot of the same issues as Elise. We fight healthcare costs every year. We have never had a year where healthcare costs did not go up. Those costs this year are going to be 30%. So in order to be competitive, and in being competitive meaning attracting and retaining the type of people in literally a zero unemployment industry, we have to be able to increase our salaries and also offer robust health care plans. One of the biggest disappointments that we've had is that we're too big to take advantage of small business HSAs, but we're not quite big enough to be self-insured. One of my clients who is self-insured has given me some insight as to the ability to see transparency in prices. You don't go to the store with a blank check and just take the cart and fill it up with anything. You know what your family needs. You are able to provide the best value with the things that you need to nourish your family. For those of us using health insurance, we go to a doctor and we don't know what the procedures, the treatments, the prescription costs are. For example, if you are told you need a knee replacement and they offer you someplace or you hear of someplace that does a great job, you go there without even thinking about what it is. You know what your deductible is going to be and some of those costs that are fixed to you. But then at the end of the year, your health care plan is negatively impacted. With our client, they told me that there's as much of a swing in our local Kansas City area of $30,000 for a knee replacement. Take that by thousands of people, and it's something that we cannot afford. The other big piece of that affects our overhead, our bottom line, and our ability to reinvest is compliance, whether it's with government contracts, federal, state, local, municipality. Their compliance reporting. I'm a small business, and we have 2 FTEs that handle compliance. And one of the biggest areas of concern is the discrepancy state by state, specifically with taxes. So those are things that as you try to grow an economy, you try to grow a business, they affect you and make you really have to look at how you are able to continue to scale and grow and be competitive.
Interesting. So I guess what I hear you saying is inflation, as you think about it, has been in healthcare and
Specifically healthcare.
as one of your largest drivers. All right.
That seems to be very widely, that and childcare seem to be quite widely felt. Yeah.
Let me ask, just shifting a little bit to how you see the economy right now, how the current economy looks to you. You heard the chairman say, you've heard me say, the economy looks to be in a good place, but that can vary depending on the industry you're in, the sector of the economy that you find yourself. So I'd be interested in hearing you compare how the economy looks today, maybe compared to 5 years ago, how you're looking ahead at it. And Lee, I'm going to start with you. If you'll introduce yourself and the segment of the economy that you focus on.
Thank you. My name is Lee Blank. I'm the CEO of GFG Ag Services. And thank you, President George, for having me today, and Chairman Powell for attending. We're maybe a little darker story than maybe the rest of the U.S. economy. To give you an idea of what GFG Ag Services does, we're a very granular company to the farm gate. We service the U.S. farmer with all of his needs all the way through his crop cycle, whether that be helping him with his financing, crop insurance products, helping him grow his acre and what he wants to produce, and then on the backside, marketing his commodities globally to the rest of the world. And so we like to say that we influence the farmer's crop cycle from front to back. And again, as I mentioned, the U.S. economy is doing well, but the U.S. farm economy really is struggling. It's an economy that's under some stress. And I think the reason for that is really threefold. And if you just think about a cash flow statement, for the U.S. farmer, his top-line revenues have changed substantially since 2012 and 2013. Those reasons really are threefold. One of those is really a glut of commodities globally, which we have seen really manifest itself in 2014 through today. Second of all would be certainly the trade environment that we find ourselves under today. And then I think third really is maybe something that most people don't recognize is the strength of the U.S. dollar. The U.S. dollar is an issue when it comes to, its strength is an issue when it comes to exports. So as I think about that, unfortunately the revenues have dropped almost 50%. To the farm gate based on the base commodities that they deal with from 2012 and 13 to today. Net farm income is I think around $88 billion is what they're projecting for 2019. It was approximately $140 billion in 2013. So it's been quite the change. But unfortunately, the OpEx of the farm gate hasn't changed. The costs of the farm gate have really maintained. Chemistry and seed genetics actually are increasing year over year. Crop input products such as fertilizers, that has changed and has reduced a bit. But really cash rents have held, which is the big part of the U.S. farm gate. It's a big part of what their expenses are, and those have held fairly stable. So it is a concern for the farm gate. But even more than that, it's really concern for all of agriculture. Previous to my role here, I was with industrial agriculture. And since really the early 80s or the Reagan administration, we've been set up to export. The whole industry has been built to export farm commodities around the globe. And unfortunately today, that's not happening. And that export environment and the trade environment has changed all of that. But unfortunately, there's been massive investment over the last 25 years to facilitate that. All of those various complexities back up to the farm gate. The farm gate is the heartbeat of agriculture. And all of those various issues back up to the farm gate. I really believe that it's not the 80s. The 80s, we dealt with a much higher interest rate. The balance sheet of the farmer today is better than it was then, but unfortunately it is fragile. And I think that the one thing that we need to watch from a policy perspective and what could affect generational wealth at the farm gate is the price of farmland. Today, farmland has held. The pricing has held fairly consistently. If that changes and we would get a drop in that, already the farmer is moving line items on his balance sheet. If his equity and his assets are reduced substantially, he'll have a very difficult time funding his farming operations, and our finance team is watching that very closely as well. So again, thank you very much for being able to share with you how things are going at the farm gate.
Thank you, Lee.
Thank you.
Are you seeing any uptick in land sales? Do you see the beginning of any of that kind of pressure in the ag sector?
There are land sales. They're consistent. What I have seen, though, is capital markets are kind of leaving the land arena. It was a very frothy market, for lack of a better term, 3 or 4 years ago, where many people were buying farmland that weren't farmers. Today, there's a lot of farmland that is changing hands, but it's more traditional in the sense it's being moved between generations and or neighbors that have been viewing this piece of farm ground for some time, which frankly is part of the reason that farm ground hasn't really retraced, is because there's enough demand and the balance sheets are okay to leverage that additional purchase into their current asset deck. So really, President George, we're not seeing a great deal of that, and that's why I'm not too concerned about it, but it is the trigger to the U.S. farm gate.
Okay, thank you. David, please introduce yourself and give us your thoughts.
Thank you, President George and Chairman Powell. Welcome to Kansas City. I'm David Warm. I am the Executive Director of the Mid-America Regional Council. We are a metropolitan planning and coordinating agency that focuses on the bi-state Kansas City region. Among our many responsibilities is tracking the regional economy and participating in broader civic initiatives to advance our overall prosperity and health. And I think from a high level, if you look over the last 5 years, we clearly have been growing. We've had about 90,000 jobs and have grown roughly at the rate of the U.S. economy. But in the last couple of years, our pace of growth has slowed markedly and is now slower than the rate of the U.S. economy. And more troubling, I think, from a civic level, we are not keeping up with our peers and have not been in the last 5 years. We are growing in our income, in our size, in our median income, in our jobs, but not at the same rate as many other similar metropolitan areas. And so as we step back and think about, well, what is going on that's making us perform somewhat differently than some of our peers, some of it we think has to do with the nature of the economy, that the industry mix here is not as broad as it is in other places where there's specialty and high growth areas that allow them to, if you will, fire on more cylinders than we are firing on, where we have a number of middling performing sectors, but only a couple of high performing sectors like IT and professional services. Some of it is our inability, like the rest of the U.S. economy, to grow middle class jobs. Middle class income household growth is about 25% of our household growth. Low income families and households are growing at over a third. 40% of our household growth were in high income. And that's different in other metropolitan areas where the middle income jobs are growing at a faster rate than either higher or lower income. And then I think the final reason is our labor pressures. And this has been said by a number of people in different ways already. We're having trouble attracting and retaining the high-skilled laborers in workforce in the sectors that really fuel the growth of the economy. We're not generating enough of our own, particularly in STEM fields. We are not advancing enough STEM degrees in this economy. But I think we're also leaving a lot of talent on the table, and I think there's been several comments made to this effect. There are a lot of people who simply have not been able to enter into the job market. What is really interesting to note, and I think this references particularly what Clyde had to say, 9 out of 10 new workers in this economy are people of color. And that's a really interesting insight. And yet, black and brown households have roughly half the educational attainment and readiness to compete as white households. And so we have some work to do, if you will, in figuring out how to unlock the problems that we face as a metropolitan economy. I think that from our point of view, having a Fed to continue to extend this full employment economy is really a fundamental capacity. It's a lot easier to deal with these challenges when there is a demand for workforce. But we also, and several people have said this, we got a lot of public policy work to do to create the tools and mechanisms to allow people to enter into the economy. And we've got a lot of civic work to do to make sure that extends to every last person in this economy, and we are not leaving talent on the table. I will say, just in closing, I think you're here at a time when we are working really hard on these sort of systemic questions of how this economy works. We are involved in some very innovative partnerships that's rethinking high school, rethinking career-connected learning, trying to build new civic capacity that will allow businesses and students to better connect, handling the K through 14 transition, if you will, either formally, if not by public policy. And that's really exciting, and we're sort of committed to that agenda and feel a sense of urgency around it. I think we also have spent a lot of money civically in recent decades in using our economic development incentives to promote real estate development rather than to promote sustained economic development. And I think we are shifting that conversation where we're beginning to think about how do we use state and local resources in ways that grows prosperity and not simply opens buildings up. And so I feel like you are here at a time where we are taking these issues on with a certain degree of urgency and intentionality that I haven't seen for a while.
Very good. Thank you, David. Leonard, tell us about your business.
Thank you. Chairman Powell and President George, thank you for having us. My name is Leonard Graham. I run an engineering firm called Talaferro & Brown. We're about 65 people with offices here in Kansas City and in St. Louis. We do civil and structural engineering, land surveying, planning, and entitlement work. Our practice is about 50% pure public works. That means working for government entities, bridges, roads, utilities, so on and so forth. And the other half of our work is for private developments. In terms of the current economic condition that we're seeing, the economic environment right now is as strong or stronger than it was 5 years ago. We've seen growth in our firm over that time period that has sustained us well. But we're operating in a pretty strong economy right now. In the markets that we work in here in Kansas City and maybe 250 miles around Kansas City and a similar circle around St. Louis, in those metropolitan areas, there's been a building boom that has occurred really since the end of the Great Recession, and that has sustained our business well. With respect to labor shortages, and that has been mentioned several times, we have a very, very difficult time in being able to locate engineers. Kansas City is a very, very large engineering center, but engineers are difficult to latch on to here. They're hard to find. What I find happening right now is all of the firms who are my competitors are poaching engineers one from another, and that's a natural part of the economy. But what that does is that causes us to have to continue to hone, raise wages, raise the offerings that we are able to give to our employees so that we can stay competitive with everyone else that's out here attempting to hire the same people. One of the things that we've started to do to deal with that is we're trying to build from within. We generally hire a few young engineers right out of school every year, and instead of going out and trying to find that 10-year mid-level manager, we started really concentrating on the new graduates and building them. We've got training programs. When they come into our company, the first thing that they do is we send them to school for 2 weeks, to AutoCAD school, because we find that the schools are not teaching that as well as they should. So we spend about $1,500 on a new employee in their first 2 weeks, sending them to school. So we're trying to build from within. It has been a good environment. As I said, a lot of projects in and around Kansas City. Stuff is bubbling and booming in St. Louis right now. So we're doing well. Looking out on the horizon, The one thing I would say is all of us who are in my business are just yearning for an infrastructure bill, because if we could get that federal money that could come out into the system, that would support continued growth and opportunity. The states don't have the money right now, and so state of Kansas, state of Missouri, you don't see as much reconstruction of bridges and highways and so on and so forth as we'd like to see. In the private markets, we have begun to see some softness out on the horizon. I watch the speculative architects. They're the people who get the projects first. Some developer or somebody calls them and says, I'm trying to do some project and help me with it. And then those things eventually come to me or to our firm and then on to construction. But I watch those guys first, and there's a little bit of softness out there, which has been a little bit concerning. I looked at the Engineering News Record, Construction Industry Confidence Index before I came in, and they're basically saying on a regional basis about the same thing that I am. A little bit of softness, no real concern about recessionary trends, say within the next 12 to 18 months, but out there somewhere we see storm clouds. But particularly with an economic cycle that's run 11 years. Something's got to happen somewhere, and we're beginning to prepare ourselves to be able to deal with those things when they do eventually come our way. What are we doing? We're trying to build backlog. We're just working our tails off to make sure that we get as much work in the door, backlogged, and ready to work on. We're starting to look for opportunities and how we can begin to prosper and maintain ourselves when things do begin to turn a little bit. But all in all, the economy is very strong. We see it continuing, but again, storm clouds in the future.
Thank you.
I wonder if you could go back to something you mentioned. And when you hire, the people you're hiring, do they need to have undergrad engineer training, graduate training? And to what extent are we just not training enough engineers? And talk about, and if so, if that's true,
Sure.
then why do you, what are your thoughts on that?
Well, David mentioned it. We're not putting out enough people in STEM fields, period. The entire world, and of course our industry, is driven by technology. Math, science, got to have it. All of the people that we hire are graduate engineers. Well, I shouldn't say not all of them. About 70% of our staff is graduate engineers. Some technicians who have had specialized training to allow them to do their work. But one of the things that I have found is with the training that engineers are receiving in the colleges and universities, they get good theoretical engineering basics. But in terms of taking that person and bringing them out and beginning to have them participate and carry their weight on a design project, they just can't do it. One of the things that they are deficient in, as I said, is AutoCAD, and which is the tool that we use for design of any of the projects that we have. And I've spoken to deans of University of Missouri, where I went to school, UMKC, and talked to some people over at the University of Kansas about educating the students so that they have more tools in their pockets to allow them to be an immediate contributor to the betterment of a firm the day they walk in the door. And so there needs to be some effort placed there.
You are doing more in-house training, though. Did I hear you say that?
Well, if it's not being done before they come to us, we have to do it. And what we have found is that it is advantageous to us to spend the additional money to go ahead and get them brought up to speed so that they can be contributors as early as they possibly can.
Thank you.
Thanks.
So your description of the economy leads me to our next question, which really is thinking about how you sustain economic growth, to think about the conditions that are facing businesses, that face individuals, that face our communities, and what some of those barriers are, what constraints there are to really a path to improved economic outcomes. So I'm going to turn that question, Beto, to you, and if you'll introduce your perspective in terms of your organization, I'd be interested in your thoughts.
Thank you, President George, and thank you, Chairman Powell, for this opportunity and for listening. My name is Beto Lopez. After spending most of my career in traditional banking, small business lending, commercial lending, I've changed my career course and currently serve as Chief Operating Officer for the Guadalupe Centers. Guadalupe Centers is celebrating our 100 years of being in service this year. So talk about sustainability.
Congratulations.
Thank you. I'll look at it from a macro perspective, if I can, for a second. Everything that's been discussed here by corporate small business entrepreneurs here that have presented, quite honestly, affects the nonprofit sector. I mean, I think I'm probably one of the only nonprofit representatives here. And a lot of the same issues that exist with inflation, wages, we have the same situation in our agency. Combined with our school system, we have over 450 employees. So $30 million plus budget. So we have to look at it from a very prudent and systematic and entrepreneurial perspective, even in the not-for-profit sector. But some of the things that we've made a commitment to in the areas that were brought up primarily by Clyde and David, and we work with organizations like Clyde and David's with Guadalupe Center, are with workforce development. We made a commitment to have a charter school here in Kansas City. We're the second largest charter school in the state of Missouri, pre-K through high school. It started as an at-risk, ad hoc dropout program, and now we're happy to say that we're getting students into college and preparing them for the workforce as well, career or college, whatever is appropriate. And we all know that not everybody needs to or has to go to college. There's other avenues. So we've made that commitment from that perspective. Also, we have a longstanding credit union, CDFI, low-income credit union at Guadalupe Centers. And through those two avenues is how we're impacting this local economy. I think not-for-profits, we're not the only ones that are doing this. There are some great not-for-profits in this region that I think we look at other ways to do it because of our limited budgets. We look at a lot of ways to collaborate. And I think that's something that we've seen other models work across the country as well. We're trying to interact best practices. But I guess the message to you all, to keep this sustainable economic growth going, which I agree, we've had a good economy, even in the not-for-profit sector. I think we need to continue to push and nudge Congress and the Department of Treasury to continue to invest and provide funding opportunities for CDFIs, low-income areas. I think that is critical for us to continue to keep this growth. CRA, I think we need to continue to encourage private lenders, in our case with the credit union, to continue to support us with non-member deposits. You know, it's a win-win for everybody. We're reaching a market, our member base with our credit union. Those are the unbanked, poor individuals in our community. Those are the people that are going to the payday lenders, and we all know what's happening in that industry. Well, we're the legitimate alternative to that with credit unions such as ours and many others across the country in urban areas. So I would just encourage you all, as you continue to decipher and come up with strategies, to not forget about that, and continue to support initiatives like Mid-America Regional Council and Clyde's work at FEC and working with groups like ours. I think it works. Thank you.
Thank you, Beto. Herb, do you want to introduce yourself and talk about how you see sustainable economic growth?
By all means. First of all, I'd like to say thank you to Chairman Powell and to you, Madam President, for having the opportunity to come here and be present and participate. It's great to be here, and I want to just start off by saying I'm a classic entrepreneur. I run a law practice, a 20-person law practice, where we do public and project finance. We started the firm in 1993. When Mayor Cleaver was the mayor, he allowed us to, a minority firm, to come and serve as bond counsel to the city of Kansas City, Missouri. Since that time, our firm has evolved, and we represent Kansas City, St. Louis, the city of New York, Atlanta, and many other major cities across the country in this area. That's relevant because over the past 5 years ago, we had an operation of 8 to 10 people. Today, we're 20 plus, and we're still growing. And we're being able to grow because of where interest rates are, because when we represent a city or a state government, they're going to issue debt based upon prevailing interest rates. So the economy has been favorable, there's been debt issuances, and that's been very helpful. On the other side of our business, we represent developers. So again, that business is interest rate sensitive as well. Developers have been stimulated to go out and build, develop hotels, multifamily housing across the spectrum. We work in all of those areas. We are, however, starting to see a softening with respect to the development side. Even though money is available for some segments of the community, I think there's been a slowdown. Our view is that we're going to remain aggressive with respect to our public finance business and continue to expand throughout the country, being methodical as we can, but also to guard against the downturn that we think will occur in the next 18 months to 2 years. We're starting to diversify our business. We're going to represent more corporations. We're going into corporate finance. We're going into areas such as healthcare and education to guard against that downturn. We think those are high growth areas that will sustain our business as well. I should also note that for the past 20 years, I've been an investor in community banks and have served as bank president of certain entities. And so the same holds there as well. Right now, we think there's an opportunity. 3 years ago, when we sold our last bank, the market was soft. The market has come back for banks. We have one under contract. If we were to sell it, that same bank today, we would make a profit just on the contract without doing anything else with that business entity. So I think that on the one hand, the economy is still very, very plus in terms of opportunities, but we still need to be cautious down the road. I should say with respect to the labor force, one of the things that we have experienced, very similar to what Leonard has, with young professionals, it's very, very hard to hire them. To hire young lawyers today, at our level, you may be looking at $80,000 to $100,000 for a salary, and that means someone who has not practiced law at all. They're not contributing day one. And so you have to take that person, invest, and hope that he or she will stay a while to recoup your investment. It's a great risk for small firms, but it's something that we're grappling with. Like Leonard, we've adopted a program where we are bringing in interns in their second and third years, hoping to build a relationship with them and try to expose them to what we do and incent them to stay a while. The average age of our team of lawyers is 58, 59 years old. So there's lots of room for growth in a very specialized industry. We're kind of like a franchise business. So if you can get in and stay in, there may be opportunities for you long term. That's my statement for the moment. I'll be open to other questions and comments.
Herb, as you talked about looking ahead and preparing for how the economy might change, you're looking at diversification. Is there something in particular that you look at that makes you cautious? Are you simply expecting a change in the business cycle? I'm curious if there's some particular aspect that you look out on.
I look at the economic indicators, and one of the things that I learned while serving on one of the boards here at the Federal Reserve are the cycles, and paying real close attention to the cycles. And I know we're out of cycle at the moment. And so, I'm not an economist, of
That's
course.
what you learned from me. Oh, no.
But I do rely on those things, as well as housing starts, labor market.
So
and
you're
those
just
kind of
looking
things.
broadly
And
across.
so I'm looking broadly
Yeah.
across and just expecting kind of the worst-case scenario. You're always thinking about, what happens that one day that you wake up, interest rates are high, it's hard to borrow money, and it is hard to access capital, which is something I did not speak to, but that's still critical for minority-owned companies to access capital as a startup or as a going concern to scale up or expand. Still, even a mature business like ours, we've been in business 28 years, and it's still difficult at times to secure the level of capital that we need to continue to grow our business. But
Okay.
to your point,
No,
we look
yeah.
broadly.
All right, thank you. Ruben, please introduce your organization.
Yeah, good morning. My name is Ruben Alonzo. I'm president of AltCap, a CDFI, or Community Development Financial Institution serving the KC Metro. I'm also a board member of Equity Squared, which is an investment affiliate created by AltCap to invest in opportunity zones in Missouri and Kansas. Thank you, President George and Chairman Powell, for the opportunity to speak here today. I guess I'll address the question from the perspective of the kind of economic and income disparities that still exist in our country and certainly here in Kansas City. As a CDFI, we focus our efforts or capital deployment in low-income communities, so we see the effects of these disparities every day. And CDFIs, by design, by mission, are required to deploy 60% of their capital in what are considered low-income communities. We believe a lack of access to capital, like Herb mentioned, is one of the main drivers of these disparities. At AltCap, we try to increase access to capital to communities and small businesses overlooked and underserved by mainstream financial institutions. One of the effects of the economic and income disparity is there are significant portions of our country that have not been able to accumulate wealth or assets. We see this with our borrowers all the time, which is why we created the Growth Loan, which is Kansas City's first character-based microloan for small business owners. This is increasing access to capital to small businesses, micro enterprises. We don't require a credit score, collateral to make these loans. We've actually made 3 loans so far. Kim Randolph is on our loan committee, so it's very much a peer-to-peer based lending model, which we've seen some very early success with that and are looking to expand that. But I would say anything the Fed can do to support CDFIs will directly support low-income communities and the small businesses that invest in those communities and create jobs in those communities. I'll also add and reinforce what was already said is that another driver of economic and income disparities is access to high-quality education and workforce training. Many of the businesses that we work with, be it a small contractor or tech-based business, tell us it is increasingly difficult to find an educated, trained workforce. Supporting strong workforce-ready and vocational training as well as lifelong learning is key to ensuring that small businesses have the labor force they need to grow and thrive. Thank you.
Thank you. So we have a few more minutes, and I'm going to open it up to any other thoughts you have on this range of questions we talked about, whether you want to weigh in more on inflation, wages, the labor market more generally. Before I do that, if there's anything in particular you're interested in listening for, I'll just turn.
Yeah, let me throw out sort of a summary of part of what we seem to be hearing today. You have a situation where businesses, and this shows up in surveys, are finding labor to be scarce. That's qualified labor with skills that can come to work are scarce, and yet, and if you, by the way, if you survey workers, people who are in the labor force, they think that jobs are plentiful. So this has the makings of a very constructive dynamic. But what we're also hearing is that there are issues that people who are not in the labor force face, and the thing that we need to do, obviously, is to get those people across those barriers and into the labor force to meet the labor shortage. And there's some very constructive answers, like as a couple of you mentioned, training. There's more training going on. That's a key thing. But there are also these other issues that are really more fundamental, like the availability of childcare and all the things that we talked about, the length of commutes that people have and that kind of thing. I think from the Fed's standpoint, we will, of course, continue to try to support this expansion, because this does have the makings of an ongoing constructive dynamic whereby we have people being pulled into the labor force, the economy keeps growing, and companies are training more, but it also feels, though, like there's a need for policies beyond just keeping interest rates low. It's really also about training, it's about education, it's about other things that enable people to make connection with the labor force and stay there. That's kind of what I'm hearing and taking away from what you're saying.
Yeah, I think one interesting dynamic that we're seeing as well, to piggyback on some comments Leonard made, and I think David as well, is we're talking about workforce development and training, not only technical workers, but engineers and professional. If we had a chancellor or dean of a university sitting around this table, I think the thing you'd hear from them is that in 15 or 20 years, their budgets have relatively stayed the same. And when we go out and meet with universities and deans of engineering schools and business schools, the pace of their funding and their resources to train and educate our workforce has not kept up anywhere near the pace of the private sector. And that training has to occur somewhere. So whether the private sector takes that burden on or the public sector, it has to happen somewhere. And where we're seeing also is the policy decisions made to fund our universities and how our universities are getting funding are being made in areas that aren't, maybe some of those decisions aren't 100% in alignment with the more urban areas. And so you've got converging forces of the rural and the urban has a different set of priorities of how do we train our next generation of business leaders and engineers. And so I don't know if that ties back to any type of infrastructure, potential spending down the future, but our university funding is something that we're really concerned about.
I'd like to just add, in addition to that, on the other side is the cost of education and the amount of debt that young people have to take on to pursue training or higher education. It's just almost debilitating, if you will. I've had young people come and talk to me about raises not so much for performance, but because of debt service related to their loans. And that is way out of sync with how we do things.
And universities are losing their professors and associates that work at universities are leaving to go to the private sector.
Yeah.
So there's
I
not.
think we have a public policy of scale, too. I mean, we got great programs. I work with David. We have a great program in the last 5 years, and you got to figure out how to keep it funded. That's just not going to get us the systematic parity that we need. And we got great things that work in rural communities. We got great things that work in urban communities. We got great schools, but it's one schools, one initiative. And the regulatory framework that governs education, quite frankly, is outdated. It is based on a 20th century model that's tied to time spent in seats and not demonstrated proficiency of skills. And so you have a lot of people coming out with degrees, they don't have demonstrated proficiency. Leonard talked about it. The workplace context of a lot of education requires that there be an integration. I know David's working on that. The Kauffman Foundation is, but everybody doesn't have a Kauffman Foundation. Rural communities don't have a lot of corporations. Urban communities are isolated, and so to the extent that we can have a commitment of a public policy scaling what works, that is reviewed because the market changes so dramatically, that's really what we need. And I think what you always see is the haves and the have-nots. You know, communities that have and have not. Rural communities that have, urban communities that have, and those that have not. And that's just where you see so much frustration, because people see these things happening in those communities and say, why can't I do that? Well, you don't happen to have this philanthropic entity. You don't happen to have a David Wong. They shouldn't be tied to individuals. They should be tied to the system and the commitment that our country needs to be able to produce at the level that it needs, because we're still a microcosm of an international economy. The way we keep up is through our productivity and innovation and technical ability and prowess. And that will not happen without us continuing to really invest in our citizenry to enable them to perform at a higher level.
And Can I also add, it's not just a public sector, it's the private sector. As you went around this whole room, everybody is investing in training, just like the union apprenticeship. We have the best state-of-the-art training programs next to the military as far as training individuals. But it is literally a private investment. If your company wants to expand, if your company wants to grow, you have to look at what the cost is going to be to invest in that training and invest in those resources for those individuals. And that grows not just your company, but it grows the economy too.
So that puts a small business out of the market because we can't afford the training. We can't afford to put people, most of the people that come to us are from the urban core, and the educational system K through 12 in the urban core is not on the same standard as the suburban schools. So your educational or your training is going to be a little more difficult. Of course, we have a lot of people that we try to send over to FEC. FEC is essential to the growth of a small business because I can get someone with the OJT program. So it is essential, and we'd like to see that continue for us to grow.
I think beyond the challenges in transportation and childcare, it's also about making the connection between the employer and those who are trying to enter the workforce, to your point, who maybe aren't in or aren't typically in. So we work with organizations across the U.S., whether that's veterans or military spouses or not-for-profits, that are a resource for those trying to enter the workforce to make the translation between what skills they have that may be transferable because they may not have a traditional resume or something that someone that is already employed somewhere is moving to another employer. There is a bit of a translation and a matching between the skills they could bring and what we're looking for, and that's a significant investment for us. In addition to, we spend over $10 million a year in training, just in paid training, not to mention the access to continuing ed that we provide at a nominal charge for 70,000 people, that they can then take that skill wherever they go. But it is a significant amount of our investment is trying to find them, to make the right match, and then trying to prepare them to be productive and successful in the roles.
Other things you think we should be listening to here? Leonard, please, go ahead.
One last comment. Impact of technology and automation. You mentioned earlier that you couldn't find people to staff your McDonald's, and so you're going to have to move to automation. Automation is coming anyway, and it's putting people out of jobs, okay? You walk into any CVS or any store where there used to be 6 checkout people, now there's 1 person and 5 machines. What do you see on the long term? And this is getting faster and faster and faster, but is there anything that the Fed is looking at with respect to dealing with such issues as we move into a greater and greater technological era?
I'll take a swing at that. So, you know, this is a 250-year-old story, and the way it seems to work is technology evolves, and what it's really doing, it's calling for people, for the society, to produce people who can operate and thus benefit from that technology. And as long as that healthy dynamic is happening, technology can advance, and you know, income inequality can actually go down, and that's sort of what happened in the United States. The United States was the first country in the world to have gender-blind secondary education for everyone. So we had a big lead coming into the 1900s, and what you saw was fast evolving technology and, you know, incomes moving up right across the board. It's a healthy dynamic. What began to happen flattened out. So we were, you know, the average education was going up, and it kind of flattened out in the United States in the 70s, and it continues to go up, but not as fast. And all over the world, people are catching up. You know, other countries are really educating people a lot, investing quite a bit. So what you see then is that the premium, the benefits of having more. The question now is, what is this? Where are we now? And with artificial intelligence and the ability to automate away, you know, low, medium, and high-skilled jobs, are we entering into one of those periods where a lot of what is now work can be done much more efficiently through automation? And will that have really challenging distributional consequences, at least for a few decades? That could be the case. But the part of this we control, though, is giving people the skills and, talents and aptitudes that they need to be able to benefit from technology. And I think if we don't do that, we're just going to see more and more of this, where some people are just left behind by what work has become. That's the risk we have. But on the brighter side, though, if those people do get those skills, then their productivity will go up, their wages will go up, and everybody can benefit.
Thank you.
All right. Well, I want to thank all of you for the insights that you've offered here this morning. This is exactly, I think, what the Federal Reserve set out to do through these sessions, of really trying to hear how you experience the economy when we talk about inflation and labor markets, to see how that looks across our various communities. So this was very helpful to us. I guess I would just repeat something that the chairman said in his remarks, which is, as we finish up these listening sessions across the country, we will be talking about what we heard, and I think with every intention to publicly report out on this in the first half of next year, so that you have a sense of what we took away from these and many other conversations. So thanks to each of you here in our community for participating in Fed Listens.
Thank you.
Thank you. Thank you, Mr. Chairman.
Thanks very much, everybody.